All right.
Hello.
Um, yes, Saban,
Yes, sir.
am I clear? Can you hear me?
Yeah, you are clear.
All right. So the last week we introduced ourselves.
Yes.
Yes, so we'll do that this week. So what we do is you put your
Okay.
camera on, and then you tell me your name, and when you work, then you move on to the next person. So we can start from you.
Okay. My name is Stephen Asamoah. I work at JA Plant Pujolu as an IT officer.
So then you put it off, and then the next person will come. But if you think the visual will not be possible, you let us know, and then you just introduce yourself for us. That's it.
Good morning. Hello, can you hear me? Good morning.
Yes, we can hear you, please.
Yes, so my name is Perisquao. I work at Presbyterian Senior High Technical School as administrative officer. Thank you.
Okay, thank
Yeah.
you. Yeah, the next person, please. Next person, please. Then we are about 11 people here, please. Let's be smart about it.
Good morning, please.
Yes, good morning.
My name is Elvis Fulajage. I work at Gapua.
Okay. Next person. Please, next person.
Yes, good morning. My name is Francis Attila. I work at Assystem Robotics.
Francis, okay. Next person.
My name is Desmond. I work at Dragon.
Osman, we have me hear you.
Desmond, and I work at Dragon. I'm currently a national service personnel at Dragon.
Okay. All right. Next person, please.
Good morning. Please, my name is Brown Noble, the National Service Personnel at the area of Lao.
Okay. Next person.
Good morning. My name is Edu Desmond. I work in South Akim at Koforidua. Thank you.
Good morning, sir. My name is Nyako Andres. Currently not working.
Sorry, you did what?
Hello, sir.
Yes.
I said my name is Nyako Andres.
Okay.
Yeah. Currently not working. Yes, sir.
Okay.
No.
And the next person.
Yes, my name is Seram Ziu. I'm a customer care service personnel in Ho. Thank you.
Oh, the next person. Oh, then. Yes. Are we done? Are we done? So far, are we in the class of those?
Yes, sir, I think we are done.
Okay. Now, last week we had a lengthy discussion, and I asked that you go and look at it. If there is any question, we will attend to it before we look at today's lesson. Is there any question from somebody? Trying to get the slide back. No question from somebody? Hello?
Hello.
Yeah.
Please, I have a question.
Yeah.
Okay, please, last week you made mention that when you are running a business and you get your business registered, the business can sue you and you can also sue the business. So my question is, how does the business sue you?
Which concept is that? From what we did last week.
Come again.
Which concept is that?
Concept.
From the notes I gave you, which concept does that involve? What the question you asked?
Yeah.
Were you able to identify the concept it fall under?
No, I wasn't able to identify it.
Then this you didn't read the note. We said that the business entity concept say that a business is a separate entity from its owner. Is that correct? So when you set up a business, you are different from the business. The business is a human being on its own, a legal human being on its own. Do you understand?
Yes.
So the business can sue you, or you can also sue the business. Even though you set up the business, but once the business has been registered, it becomes a separate individual under the law. Are you getting it?
Yes, please.
So once a business is registered, it's have a separate entity, legal being to the owner. So you can't say, because this is your business, anything against the business is against you. No. Once it is registered, the business is identified as a separate person from you. So if they are looking for your business, they are not looking for you. If they are looking for you, it is not your business they are looking for. By law. You understand? So if the business has done something you don't like, you can sue the business. In the same way, if you have also done something against the business can sue you. Do you understand that? Or still? Hello? Hello? The one who asked the question, are you okay? The person who asked the question, is he okay?
Yes, please.
You are okay? Okay. And then any other? Any other, please?
Hello, sorry, my network here is not stable. Sorry.
Okay, I can see that.
Yeah, please, I'm okay.
Any other person having any question?
No,
Hello,
please.
sir.
Okay.
Hello, sir.
Hello.
Yes, sir. Please, since the business, you are the owner of the business, how are you going to sue the business, or how is the business going to sue you? Because at the end of the day, if you sue the business, you are suing yourself. I don't know if you get my.
If you see the business, you are not seeing yourself. We said that into the note I gave you and read it, look at business entity concept. If you read it, it says that the concept implies that the affairs of a business are to be treated as being quite separate from the non-business activities of its owner. You understand? The items recorded in the books of the business are therefore restricted to the transactions of the business. No matter what activity the proprietor gets up to outside the business, they are completely disregarded in the books kept by the business. The only time that the personal resources of the proprietor affect the accounting records of a business is when they introduce new capital into the business or withdraw from the business. Okay? Are you with me?
Yes, sir.
Now, when there is something legal against the business, the owner can only stand as an agent of the business, but he is not attacked as a person. Do you understand?
Yes,
Hello.
sir.
And so,
Yes, I understand.
so for instance, if the owner had worked for the business or had borrowed money to the business and the business is not paying the money, he can sue the business for the money. Do you understand? That is an interesting thing created by the law. And the law says that the owner is separate from the business. Completely separate from the business. But you see, sometimes if the law states that if the owner working for the business did something wrong, that's when the law can go under the issue and find out who did it and catch up with the owner. That's why we call it the lifting of the veil of incorporation. The veil of incorporation is what blinds, what differentiates or what covers the owner from the business activities. Everything we say, the business has done this, the business has done it. But when it gets to a point, the law can remove that veil of incorporation from the business and then go under to see who the person, the individual, okay? Have I answered you anyway?
Yes, please.
Okay. So it's a law or a legal framework created by the law to protect the businesses and the owners. That when a business is registered, it becomes a separate legal entity and is distinct from its owner. So if you open an IT firm, it is you who have opened it, but if there is anything the business has done that you don't like, you can sue them, you can sue the business, and the law permits it. Okay. Are you okay?
Yes, sir.
Okay. So, any other person?
Sir, please, I want to ask that if you see your business, how the judgment going to be like? Because for my perspective,
I can hardly hear you.
I was saying, how is it going to be like if you see the business? Because
To sue the business.
Yes.
How is it going to be like to sue the business?
Yes.
And
like,
that is what I'm saying, that is, you take this one like this. You see, when you register a business, the business has become a separate human being on its own, with everything legally human. separate from you. You understand?
Yes.
Okay. So if the business is assuming a separate legal entity as an individual and has rights and responsibilities, then you too, you have your rights and your responsibility. And one of those things is that you can sue and they can also sue you. You understand?
Okay. Yes.
Uh-huh. I want to move on, but I want to share something with you from a book. So I'm using the book. After that, I'll share the book with you. Today, I want you to get a fundamental overview of financial statements. Okay? Now, as an IT man, you should not be handicapped when they talk about financial statements or when they bring the financial statement to a meeting that you are part of. You should also be able to understand what it means or what to expect and be able to contribute to the argument or the discussion. And so when we talk about financial statements, it's a list of financial records that were put together. Are you with me? Now, it has about 4 components. And we will be looking at the components of a financial statement. And then we'll see the individual items that are expected to be in it. So the first one we'll look at is the statement of financial position. Statement of financial position. It is also called the balance sheet. The balance sheet. What does this statement tell? We said that the balance sheet or the statement of financial position, as the name depicts, is a summary of all the company's assets, liabilities, and its equity. It shows the financial state, the financial health, the financial position of an organization. And it summarizes all the assets, position, the liability, and the equity position of that organization. Is that okay? Now, the accounting equation or the resources of every organization is equal to what is owing others and what the owners bring in. I'll repeat it again. The resources, which is the assets of every organization, is equal to the organization's obligation that it owns others, which we refer to as liabilities, and the resources that the owners bring into the business to form it, which is the equity. And we are saying that the balance sheet or the statement of financial position is the same thing. Gives us or reflect the company's financial position at any given point in time or at the end of a financial year. Are you with me? So if you want to know an organization's position, one of the things when you get hold of that can give you the position of an organization, it is its statement of financial position, or what we call balance sheet. Now, again, if you want to know what's in the balance sheet, the first thing you see in the balance sheet has to do with the assets. In a layman's word, we can say the properties that the business is having, that is its assets. Now, the assets are categorized into two: the tangible assets and the intangible assets. Now, tangible assets are the things you can see and touch. Example, land and building, cash, machinery. Those things are assets that you can see and touch. Then we also have an asset that is intangible. For instance, the good name, the organization, it brings in money. Let's say if you are going to buy an electrical something and they say the thing is Samsung or LG, it creates some perception in your mind for you to conclude on one. You said, this is a good brand. This one is a good brand. Let's say a car. You say Hyundai and Toyota. You say Toyota is a good brand. It's a known brand. You have tried it and tested it, and you know how the products are. It has a good name. And so many people will want to patronize things from them to maybe the other one. That condition created is a goodwill of the company. It's also a property of the company. If you tarnish it right now, then you tarnish an asset you can quantify for the company. Patent rights. They are rights given to someone to maybe produce in the name of somebody, or to restrict others from dealing in a particular thing. It was meant for you alone. Maybe you are the sole distributor of Toyota brand in Ghana. It's a patent right given unto you. That is also an asset. But you see, this asset, you can't touch it. They are not something visible, but it has effect or impact on your business dealings. So those group of assets are also called intangible assets. Now let's come to the tangible assets. The tangible assets too can also be classified into two. We have the current assets. We have the current assets. They are those assets that can be easily be turned into cash within 12 months. Those class of assets that can easily be liquidated. When I say liquidated, means turned into cash within 12 months or less. They are what we call current assets. They are resources that are available for immediate use. Example is cash in hand, the money you have in hand, and then accounts receivables. They are people who were owing you that you can, your debtors, which you can go and collect the money. Inventory. They are your stock that you have in your warehouse, which you can sell and get money. Prepayment. The prepayment are monies you are paid in advance. Like you pay rent in advance. If you don't need advance payment again, you can go for your money. So they are your assets that you can classify as your current assets. Now, when we talk about cash, we have cash and cash equivalents. The cash itself is the cash that you have in hand. And then the cash equivalents, they are those things that they are already in the form of cash, but they are not physical money. For instance, if you have made an investment in maybe a short-term investment, let's say fixed deposit, you can walk to the bank and discount it and stop it and take your money. So those are all your bank balances. They are not cash you are holding in hand. It's the money that you have in bank. You can go in for it. So we call them cash equivalents. So the cash and cash equivalents, they are part of your current assets. Now, your receivables are those who were owing you. You sold things to them and they are owing you. You can walk in and collect your money at any time. And I said inventory is the stock that you have for sale. And it can be a raw material that you have in stock, or it can be a work in progress, like something you are developing. Or it can also be a finished product that you have developed, is waiting for sale. Those are what we call inventory. The prepaid expenses are payments you have made for future benefit. You can stop the benefit now and go for the money. All those things I've just mentioned, they form part of your current assets. If that is okay, if there's any question, you can ask. So we look at assets that we have tangible and intangible. We saw that the tangible can be divided into current and non-current. And we saw the current assets, an example of which are the cash, the inventories, the prepayments. Those were some of the examples we gave for the current assets. The bottom line is that the current asset can be liquidated or turned into cash within one financial year or accounting period, which is usually 12 months. All right. Now, if there's no question, then we will now look at the
Sir,
Yes.
yeah, so for the prepaid expenses, can an insurance be an example of that?
Good. An insurance cannot be an example. An insurance cannot be an example because an insurance is based on occurrence of some event. If the event did not happen, you can't go for the money. You get it? But these ones, they are things that are already at hand, which you can turn into money. So you cannot consider insurance as a current asset. But if you have prepaid the insurance, if you have prepaid, you paid the insurance in advance, then that prepayment, when it is not utilized, can become an asset to you because you can have that in future. Have you seen the difference?
Yes, sir.
Okay. Now let's come to non-current assets. They are assets that cannot be immediately turned to cash. It takes time before they are turned to cash. An example is property, plant, and equipment. All properties, all plant, and all equipment. So land, building, office machines, etc. They fall under non-current assets. These are long-term assets like land and machinery used to provide goods and services. Their depreciation is recorded over time, affecting the balance sheet. So those assets, what happens is that as you are using it to generate income, you set aside a value every year for its usage to reduce the price. So at the end of its useful life, you can be able to acquire another, or you'll be able to pay for its price. Does it make sense? And these are shown in the balance sheet or the statement of financial position. Now, other assets. The other assets include the intangible asset not categorized elsewhere, like patent and then the trademark or goodwill, like I explained. They are not tangible, but they form parts of income generating resources. The name of the company can attract people to go there and make payment. And so if you want to buy that company, they may sell the whole company to you above the price of the physical items that you see in the company. The excess of the price of the physical items and then the value you bought it is termed as your goodwill, the goodwill of the company. And it is also recognized as an asset. So if you are going to buy a company that doesn't have a goodwill, you see that the value of that company will be less. If you're buying a company that has goodwill, you see the value will be higher comparatively. I hope you are following me. Now, in that same statement of financial position or balance sheet, you will also see the company's liabilities. And the liabilities are the obligations of the company to others. In other words, what the company is owing others is their liability. And so we have this liability also classified into two. We have the long-term liability and then the short-term liability, or the current liability and non-current liability. Like the name indicated, usually the current liability are liabilities that the company owes within 12 months. Within 12 months, which is one financial year or accounting period. Anything beyond that, then it becomes either medium-term or long-term liability. So for instance, if the firm borrowed 200 cedis, are you with me? If the firm borrowed 200 cedis, and that 200 cedis, they are supposed to pay 100 cedis this year, and then the following year, they pay another 100 cedis. When they are accounting for that loan or that borrowing, they will account for the first 100 cedis in their books as current liability. It will be due within 12 months. Then the rest will be pushed into the non-current liability. So current liability, they are short-term obligations such as accounts payable and accrued expenses. Maybe you are owing electricity. You have to pay it, you pay it before the otherwise they'll come and cut the water light for you. So those things are seen as current liability. Or you buy goods from somebody on credit for you to go and pay the person. It's also a current liability. Now, long-term liabilities are long-term obligations of the organization. So let's say bonds and debts, other debts other than the visual credits. So, and then long-term loans. If you take a loan for more than 2 years, it becomes a long-term liability. Bonds are also long-term liability when you collect monies from people for a number of years before you return to them with interest. Okay. Now we have something called current ratio. Current ratio. Now, the current ratio is the rate at which a company is able to pay its short-term liabilities with its current liability. The explanation is that the money you are holding in your hand, can you use it to pay the things you need to do today? So when you see a company's balance sheet and you are able to identify the current assets and the current liability, you'll be able to calculate the current ratio. The current ratio is the ratio at which an organization will be able to meet its short-term obligations with its current assets. A measure of liquidity calculated by dividing current asset by current liability. A ratio greater than 1 suggests a good ratio or adequate short-term financial health. Are you getting it? So as an IT person, we need a financial statement to be able to know whether a company is a good company for you to invest in or not. And one of the ratios you can use to know is if you divide the current asset of the company by its current liability, it should be 1 or more. Anything less than 1, then it is not a good one. When it is 1, what it means is that the company will be able to pay its debt or its current liability with the current asset that it has. So the higher the ratio, the better it is for the company. Let's say if it is 2:1, what it means is that you will be able to pay your debt with the liability, the assets you have 2 times. So that company is better than the one that will be able to pay only 1 time. Yeah. Any question on that? Any question on that? Any question on that? Should we continue? All right. Now let's look
Hello.
at, yes.
Yeah, sorry. Can you go over it one last time? Sorry.
Which one?
The current ratio.
We said the current ratio is the total current assets divided by the total liabilities. Current liabilities. The total current assets divided by the short-term liabilities. And we're saying that that ratio tells you how many times the company will be able to meet its short-term obligation with the short-term asset that it has. How many times can the company pay its debts using the cash that it has now? And we're saying that it should at least be a ratio of 1:1. If it is higher, then it's better. If it is 2:1, what it means is that the money the company is having can pay its debt twice. Please, do you get it? And I said that that ratio is used, you can use it to appraise an investment in a company to find out whether this company is doing well, whether it has the capacity to pay its debtors with the resources it is having. Are you okay?
Yes, please. Thank you.
All right. Now, the same balance sheet also shows us the shareholders' equity or capital. These represent the residual interest in the company after subtracting liability from the assets. Now, all what capital means is the resources invested into a business by its owner. The resources invested into a business by its owner. So let's say if the person wants to start a business and then he brought in his own money, 200, and then he went in to borrow money, 100. Then the total capital he's using in that business is 300. So that 300 is referred to as capital. But that capital is divided into two. The one he brought in himself, the 200, is what is referred to as the shareholders' equity. Does it make sense? Is there any question on that? Is there a question on that?
Yeah, please go over the shareholders' equity again.
So we said shareholders' equity is part of the total capital of a business. Now, we said the capital of a business or the equity of a business is the amount of resources that were brought together to start the business or to run the business. The portion of that capital that comes out of the owner into the business is what is referred to as the shareholders' equity. And I said, if you start business with your own money, 200, and then you went and borrow some money, 100 cedis from some place to add to it, make it 300, and you start the business with 300, your capital that you start the business with is 300. But your share in that capital is the money you brought into the business, which is the 200. So that 200 is what is referred to as the shareholders' equity. Does it make sense? Yes, Collins.
Yes, please.
Yeah.
Collins, obeying
Sir.
your question.
No, I don't have a question. I was applauding.
Okay, I saw. I thought to say. Now,
Yeah.
now let's look at this. That shareholders' equity can be brought in different forms. It can be in the form of assets. It can also be in the form of, and it can also be in the form of goods. So let's look at it this way. You want to start a business and you have a house already. You want to use that house, the building. You want to use that building to start a business. And so you put the business into the business. You put the building into the business. The cost of that building that you have put to start the business is part of your equity contribution. You can also bring in physical money, and that physical money is cash. That can also be part of your equity. Now, let's say your business is selling of land, and you already have some of the lands before you want to start, and you demarcated about 20 acres to use to start the business. That land is in the form of the stock, the item you are dealing in. So it is in the form of stock that you are using to start the business as your equity. Does it make sense? Do you understand?
Yes, sir.
All right. Now, if it is a company, you can issue what we call shares. The shares is a name given to a portion of ownership in a company. Maybe you want to start a company with 100,000 and you decide to share it, that anybody who wants to have a part in it, 1% is 100 cedis. So each percentage is 100 cedis. So the entire 100% will give you the 100,000. So if a person takes 1%, then he's owning one share. And the value of those shares pulled together forms your equity. Now, the individual value brought together gives us what we call stock, share stock. So if you need money for a company, to raise a company, and the company is registered on the stock exchange market, you can float shares and people will come and buy it. And then when they buy it, they are bringing in the money for you to use to do business. And that is what we refer to as fundraising through the stock issuance or stock market. Please, do you understand? So
Yes,
if you
sir.
see Commercial Bank and MTN at a point in time, they want the public to come and invest in them. And then they said they have issued their shares and people will go and buy the shares and they have investment in the company. Then that is what we call the share capital. They have invested in the business by contributing to the capital of the business. All right. Some of these ones might not be so relevant to your level. Additional paid-in capital. They are, if some organizations will give you the capital you are to contribute, and you pay some immediately, and then later you bring in some, and that is what is called the one you are paid is called pay up capital. The one you are yet to pay is the yet to be paid one. And a term like retained earnings Retained earning. So once you have invested in a company, you expect that when they make profit, you should get your part, a share of the profit. Is that not it? Fine. Now, when we say retained earning, what we are saying is that after you have made profit, and then you have paid all the dividends to those who invested in the business, the profit portion that is left, and you keep it in the business and use it for business, is what we call retained earning. Retained earning. So retained earning is the retained profit that has been kept in the business. Is that okay? Now, I will share this. I've just adopted, I saw the explanation on this document, very interesting. So I've adopted it to explain to you. I'll share the document with you for you to go through. There are some of the things that will open your eyes as a 90 person who is studying business. Now, let's look at the income statement. So we have now looked at the statement of financial position or the balance sheet. Is somebody having any question to ask about the balance sheet? Otherwise, I will ask you a question.
So I want to ask, what are the factors that are used to determine the stock price? So let's say you want to put share in your company. What are the factors that will determine how much a share will cost?
Now, for a stock, the pricing of stock is determined, one, by the amount of money the company wants to raise. You understand? The amount of money the company wants to raise. In fact, the initial issuance is determined by the amount of money the company wants to raise. Then the subsequent ones is determined by the performance of the company. This is how it happens. When you are starting the business, you just float the stock. Once you are registered on the stock exchange and you have the permission and the license, they float your stock. You want to raise maybe 100,000, and then they float your stock on the stock exchange, maybe 100 cedis per share. Now, the business is doing so well that the profit you shared to the shareholders last year was so good. Then you see that now people want to buy more. People want to owe more so that they can get more. That can raise the price of your stock in the market. So the performance of the business also raises the stock. Also, the quality of employees or managers of the company can also increase the stock price. Let's say if all of a sudden a very powerful businessman, people like Sam Jonah, people like some time ago in Stanbic Bank was this man, the Alassane and Danny also. Those people, when you have them in your business, then all of a sudden they said they are resigning today. It can affect your stock price. Can affect your stock price. Because people believe that because they were there, that is why your company is being very profitable. So if they leave, the company might fall short. And so you see, it can affect the stock price of your company. Have I answered your question?
Yes, please. It's clear now. Thank you.
Okay. So we are now coming to the income statement or statement of financial performance. Statement of financial performance. Now, the income statement shows the total revenue generated by the company or the entity within the financial year. And then the total expenditure they have made in generating that revenue in that same period. Does it make sense? So the income statement reflects an enterprise profitability. It's calculated as the revenue minus the expenses, and that will give you profit or loss. So the components of the income statement or statement of financial performance, the first thing to look for is the revenue. And the revenue are recognized when they are earned and reliably quantified. When the revenue are earned, in other words, when they are collected, if it is sales you are making, if it is something you are selling, you can only say you have earned a revenue when sales is made. If it is service you are rendering, then you can also say you have earned revenue when the service has been rendered. Does it make sense? So the basis of this is that you can say you manufactured 20 pieces of phone, and that 20 pieces you haven't sold it, but you know that you sell one at 1 cedi, so you are getting 20 cedis, and then you count that as your revenue. No, sales has not been made unless you have made a sales either on credit or on cash base. Once the goods are sold, then you cannot recognize the revenue. Okay. In that same statement, you can also find the cost of goods sold. Cost of goods sold. In other words, cost of sales. Now, that is the direct cost of manufacturing reflected when goods or services are sold or expenses are incurred. The revenue you have generated, what expenses did you make that are relating to this revenue you have generated? All those expenses put together is what we call the cost of sales, the cost of goods sold. So if it is a manufacturing and you are manufacturing a shoe, you bought the leather, you bought the sole, and then the workmanship. When you put all together, it gives you the cost of sales. That is the cost you incurred in manufacturing the thing. Then when you sell it, the sales that you made now give you the revenue, and the cost of producing it gives you the cost of goods sold. Does it make sense? So when you subtract the cost you incurred in manufacturing or putting the goods together from the amount you sold it, what's the balance you get? If it is more than the cost, then we call it your gross profit. Your gross profit. Is anybody having a question at this level? As at this level, where we have determined gross profit. We said the sales that you have made is the revenue. The expenses you have made directly to manufacture the goods or to get the service rendered is the cost of goods sold. When you subtract the cost of goods sold from the revenue, then you get your gross profit. Are we together?
Yes, sir.
Should I continue?
Yes, sir.
Now, when you get the gross profit, remember that all other expenses are not part of your cost of goods sold. The cost of goods sold is only the direct cost that you incur in getting the good produced. But you see, the company will pay electricity, and the electricity is consumed by administration, it's consumed by manufacturing, it's consumed by other units. The company will pay security man. The security man did not contribute in the manufacturing of the goods, but he was protecting the company. So there are some indirect costs or there are some indirect expenses that are not part of the cost of producing the item that you have sold. And those expenses are what we refer to as the operating expenses. Now, after subtracting the operating expenses, the selling and general administration expenses, if you are doing research and development, the research and development expenses, if you are doing advertising, the advertising expenses, if you subtract all those expenses from your gross profit, then you will now get what we refer to as net profit or your operating income. I'll go over that one again. What we are saying is that you have manufactured something, let's say one computer, and you sold that computer for 2,000. The total amount that you sold, which is the 2,000 CD that you get from the sale, is what is referred to as your revenue. Now, in manufacturing that computer, you use component parts. You use software. Now, the cost of the software, the cost of the component part, the hardware parts, they are direct cost to manufacturing the computer. And then the personnel you use in assembling the computer together, that person also contributed directly in manufacturing. So the salary you pay that person is also directly involved. So when you put those expenses together, it gives you the cost of producing the computer. Now, when you subtract the cost of producing the computer from the sales, which is the revenue you made, you now get a gross, what we call gross profit. The gross profit. We call it gross profit because everything is inside. Then we said, but you did some operational expenses whilst you were producing that thing. It includes your electricity bill for the room you were using to do the production, the compound you were using for the production. You rented it. Maybe you have used some water to clean some things. The washroom, you use it. Those things, they are not directly part of your production expenses, but they contributed to the company running in order for you to be able to produce the thing. You have some secretary in the office who is receiving your letters and signing documents for you. That secretary is not part of the production team. It's not working directly, but you are paying him too. So that person is also bringing some expenditure. Then you have a team that sit down to research and see, what type of computer should we produce? What type of computer are people liking these days? Which part of the country do they want this type of computer? They are researching into those things. They are not doing the thing directly, but that their research will also have effect on your production. And so expenses that you spend on them should also be deducted from your gross profit in order for you to get your net profit. Are you getting it? Now, there is something we call depreciation. It's the value of wear and tear, the value of the reduction in value of a fixed asset. So let's say you are using a tool to produce something, and let's say a hammer. Every day you are using the hammer to hit on the thing, and you are producing the thing all right. But you should not forget that the hammer too is growing old. And so the portion of the usage that you assume you have used is what we call the depreciation. It has reduced in value. So you charge that value against your profit. And after deducting all those expenses from your revenue, then you are going to get what we call your operating profit. Any question? What I want you to get from this lecture is to get the components of a financial statement and the various items in each component. We have looked at the balance sheet. We saw asset, liability, and capital, and their various types. Now we are looking at the income statement or the statement of financial performance. And we are looking at the revenue. We are also looking at the cost of goods sold, and then we are now looking at the other expenses, other operating expenses, administrative expenses, depreciation, and then that will give us an operating income. Then after the operating income, if you have any interest from bank on the loan you have taken, then you charge those, or you In accounting, if we say you remove it from it, it's same as you charge it against. You charge those expenses against the operating income. And then you now pay your tax. And after paying the tax, then you have your net income. You have your net income. So the net income is after paying everything. Then the net income is what is left for the owners or the shareholders to share. The owners or the shareholders to share. So as an IT person, one of the benefits you are getting from studying accounting is if you invest in a company, you want to see their net income. And you want to see what was the revenue and what did they subtract from it before they got this. Then you begin to engage them. Now, when they get the net income or net profit, then you are sure that that is what you'll be sharing. Now, normally, the annual general meeting, the owners will decide that, okay, this year we are not taking anything, or this year we are taking maybe some percentage of the profit to share for the owners, and then we reserve the rest in the business to be used to do further businesses. All right. Now, so what they share to the owners of the business is what we call dividend or earning per share. So after paying that, whatever is left, we refer to it as retained earning. Retained earning is what is left in the business to be used by the business for the improvement of the business. Please, do you understand now? And so it's the same thing repeated here, just to throw more light, but because I've taken my time to go through. When you read it, I'll share this with you. This is, I've adopted, it's a book I've extracted. I've adopted this side of it for you to use it, bring the thing so clear. And so when you read through, you understand more of what we just look at. An explanation of the various components that I've talked about. Okay. Now, the next thing we want to look at is the cash flow statement. If you remember, we said we are looking at financial statement. And then we said the financial statement is made up of balance sheet or statement of financial position. It's made up of income statement or statement of financial performance. And then it's also made up of cash flow statement. Cash flow statement. So we have looked at the first two, the balance sheet and then the income statement. The things you should be expecting and the meaning of those things. Now we want to look at the cash flow statement. Now, the cash flow statement basically look at the movement of cash in the business, the inflow and the outflow of cash in the business. That is what cash flow basically look at. So we said that the cash flow has some elements that we need to look at. And the reasons for the cash flow are the things we want to look at. Now, sometimes you will notice that a business will come out and this one, the operating, the income statement will say that they have a lot of profit. They have a lot of profit. But when you go to them, they don't have any money to show you. So somebody will ask me, what does that mean? That you have declared profit, but the money, you can't find money in your hand. What does that mean? The cash flow statement will explain that. So we want to look at profitability versus cash movement. Profitability versus cash movement. So I'm reading this one. Whilst the income statement illustrates profitability, the cash flow statement captures cash movement from various sources and their uses. Are you getting the difference? So let's look at the cash sources and the uses. So when we are looking at the cash sources of cash inflow, we are basically looking at how or where we got money from into the business. Where we got money from into the business. And once you get the cash flow statement, it will help you to know where they got money from into the business. Money could be gotten from sales of products. Sales of products. That one is when you manufacture something and you sell it, it generates cash. So you can generate cash from sales of product. Cash can also be generated from bank loans. Bank loans. So an entity may go to the bank and borrow money to run its business. So you can see that there's huge profit over there, but then the whole money is coming from what? Bank loan. It can also come from share issuance. They can issue shares, like we said from the beginning. They can issue shares, and people who subscribe to the share will bring in money. It can also come from account receivable collections. Money can also come from people we sold things to them on credit, and they are now paying us. We can also receive money from them. Then, when we are looking at where spendings are going or our outflow, you can also look at payment that we are making to people who supply us, or money we are paying back to those who have lent us, or we have the shares that we issue. We said we don't want many people to be owners of the company, so we are buying some back. That's one too. We spend money, and then we can also spend money through paying dividends. And I said dividends are like profits paid to shareholders. Okay. So we have seen the two sides, where money can come in and then where money can go out. Now let's look at the structure of the cash flow statement. Now we have the initial cash balance. The initial cash balance. The statement details cash and cash equivalent at the beginning and end of the reporting period compared with the balance sheet. So the money that you have accumulated or used to start the business is your initial cash balance that you have. And that is what you have in the business before you are building on to. Okay. Let's pause with some few questions. You want to ask yourself, where did you get the money from? The sources of your cash. Where did they come from? What type are they? And how did you spend it? These three questions are the basic things that the cash flow will assist us to answer. Okay. Now, let me go back to the cash flow. Let me give you some more information to it. I think we don't have it on this slides, on this sheet, but I'll make sure I get you. In our next meeting, we will be looking at the format of the statements. So we have cash flow that has about 4 components. We have the operating activities. Cash that comes out or goes out from operating activities. Now, operating activities have to do with the day-to-day running of the business. So the day-to-day running of the business, those activities can bring in money or take out money. So for instance, we say sales. Sales is an operating activity. If we sell and have money, it brings in an inflow. What about advert? When we make an advert, we pay. It's also an operating activity, but this time it's taking money out of us. So we call it an outflow. So when you take the money you use to start a business, and then you add the money that you got from sales, and then you subtract the money that you pay to advert, what is left should be equal to what you have left in your bank account. Does it make sense? I want you to ask questions. Desmond.
Sir, please.
Yes.
Sir, please go over the initial cash balance again.
What I'm saying is that your initial cash balance is the total cash you have either at the bank or in your hand to start the business with. Is that correct? Now, any sales you have made brings you money. So you add that money to the initial one. Any payment you have made as a form of expense, take away money from you, is an outflow. So you subtract it from it. When you do the plus and the minus, the balance you should have should be equal to the money you have at your hand or in the bank. Does it make sense?
Yeah, thank you.
Okay. Desmond, I wanted to know if you are okay.
Yes, sir.
All right. So that is for the operating activity. Operating activity is the day-to-day activities that goes on the sales and then the purchases involved. Then we have financing activity. Financing activity. Financing activity has to do with the things you do to add in more money. Add in more money. So, for instance, if you take a loan, it's a financing activity. So, if you take a loan, it will increase your cash that you have. Is that correct? So if the cash balance that you have, and then you add the operating activity, which is the sales that you have done, you add it to it, the cash you receive from sales. You add it to it, you subtract the expenses you did through advert, and then you add the loan you collected to it. It should give you the balance you have at the bank. Is it clear? Good. And then the next activity too, we call it financing activity. Financing activity. No, I've talked about financing activity. So we're talking about investment activity or investing activity. So all the activities you did in acquiring additional assets for the business, when you add all of them, you see, the more you acquire an asset for the business, your cash is what? Going out. Please, does it make sense? When you acquire an asset for the business, your cash that you are having, you are paying out of it. So money is going out. And the rule is that after that money has gone out, the balance you should have should be equal to what you have in your bank. Is that okay? So the cash flow show you the movement of your cash in and then out. And it is classified, the activities that can bring in and out of your money of cash is classified into operating activity, financing activity, investing activity. When you put these three activities together, the balance you get should be equal to the amount of cash you have at hand or at the bank. Is that okay? Okay. Some portion of this one are not necessary, but it's a PDF document. So when I send it to you, you take the first portion of it is what we have looked at today. The first portion of it is what we looked at today. You just take your time and go through carefully. The next time we meet, we'll look at the account itself. Look at the account itself. And then we'll see how you can prepare it. You can prepare. You are not expected to go so deep into it, but you should be able to prepare the basic financial statement when given the necessary thing. You should also be able to understand the financial statement when you take it. So without much, today we will end it here. Oh no, one to explain. After the cash flow, we have the notes to the account. The notes to the account. And the notes are additional information that are provided, which you will not see in the figures. They are additional information you will see in the account, which are not in the figures. For instance, depreciation policies. Depreciation policies. Some company will say that when they buy a vehicle and the vehicle is used, they expect that the vehicle will last for 5 years in the organization. So what it means is that each year they are going to use a portion, they will write the portion of the vehicle off the value. They will depreciate it by that value. So let's say if we say 5 years, what it means is that the vehicle will be depreciated 20% every year. At the end of the 5th year, it means the vehicle doesn't have value again. They can dispose it. So every year you charge the 20% of the cost of the vehicle against the revenue. The note will tell you the policy of the company. The note will also tell you other information that leads to the preparation of the account and of the financial statement, in other words, the account. And when you read through them, it should be able to give you adequate information for you to determine whether this company is doing well or is not doing well. In our next class, we will look at a typical financial statement, and then we will try as much as possible to analyze it and see some of the information you can get from it to take a decision on financial statements. Yours is more of a management accounting than financial accounting. And so as I introduce you to the accounting, we will also move to management accounting. But you need to know about the financial statement very well, the components, and then the various key indicators in them. Then we can move on to the other side of the management accounting. Thank you very much. If there's any question, let me know. I will be sending you this afterwards. I'll send it to the class rep and then he'll share with you. Any question? Please, any question? You can unmute yourself and talk. Sarah.
Sir.
Any question so far?
No, please.
So as at today, if someone come and ask you what is financial statement, can you tell him something?
I'll try.
Even though you are an IT person, can you tell him something?
Yes, please.
Okay, so let me ask you, what is an income statement? From what you have learned, when we say an income statement, what do you just tell me your idea about it?
Okay, so I understand it that is the money the business earns and how much the business also spends within an accounting period.
Very good. So the money the business earns, how do we call it? Anybody can answer that question. How do we call the money the business gets or earn? How do we call that?
That's the revenue.
Very good. Very, very good. I think I'm getting proud of you. So that's the revenue. So Sayram is telling us that the income statement shows the revenue and the expenditure of an organization. That is good. That is good. That is good. Okay. So who also want to talk about something? Francis.
Yes, sir.
Tell us what you know. Right now, what have you learned about an income statement?
I mean, I think with the income statement is the core aspects that gives an overview of the business's standing. That is what I've learned about the income statement.
So the income statement doesn't show the business standing. What shows the business standing is the statement of financial position or the balance sheet.
Oh, okay, yes.
But the income statement, it shows the revenue and then the expenditure. You understand? Mm-hmm.
Okay, so looking at the business statement, can't you make a conclusion? Because if you know the revenue and the expenditure, doesn't that also give an overview of the business?
Yeah, you give an overview on the expenditure and the revenue side, but doesn't give the position of the business.
Okay.
Mm-hmm. The position can be gotten in the assets, liability, and capital. And those three things can be found in the balance sheet or the statement of financial position. You get it?
Yes, sir.
Yeah, thank you. And then I want one lady to also tell us something he knows about the cash flow. Do we have some other lady in the class?
Please, I think I'm the only lady.
Oh, okay. Then, Sefa, the class rep.
Hello, sir.
Steven, tell us what you know about the cash flow.
Cash flow. Okay.
You were disconnected.
No, please, I'm on.
Mm-hmm. Okay, for making another on the cash flow.
Okay.
Sir. Hello, sir. The cash flow. Hello.
Hello, sir. Hello.
You too, please.
Yeah, please. The cash flow. This talks about how the money moves in and out of the company.
Very good. So we call it the inflow and outflow.
Okay.
Mm-hmm. That's fine. So now, Andrews, do you have any question for me?
Sir, I was answering the cash flow, but it seems that's what how money is moving in and out of the business. That's what I was saying.
So you are okay. I'm looking for those who never talked today. There were some people, I never heard of them. Thanks. School is there, it's a joke.
Hello, yeah, I'm here.
Mm. When we say the current ratio, what are we trying to say?
Um, yeah, current ratio. So with that one, I understood that it's the rate at which the company is able to pay its short-term liabilities with the current assets.
Excellent. No,
Sir,
can you tell us the classes of assets?
the
Classification of assets.
hello,
Hello.
sir,
Yes. Can you get us?
sir, please the question again.
I'm saying the classes of assets that you can remember.
Okay, cash.
That is a type of asset.
Okay,
But the
current
classes.
assets,
Yeah. And then
non-current assets.
very well. That's good. Have you people learned accounting before?
No, sir.
No, please.
Then you are doing well. All right. We'll end the class here if there's any question. Is there any question?
No, please.
The class rep, please try and send me the class list
Okay, okay,
so I can also monitor the attendance.
okay.
All right. So we'll meet next week.
All right.
But I'll be sending you people some materials through the class rep within the week.
Okay.
Beginning, I was asking that you introduce yourself and tell me what you do. The reason is I wanted to see how busy and how available you are. Now, with accounting, it's not a reading subject that you put it down, and when it's getting to exam, you go and study it, and then you are gone. No, it is more of practical. And so at least you look at it 30 minutes or 1 hour a day. You try your hands at some of the calculations. And so you just started studying it. Don't let it rest. Go over the notes
Yes, sir.
so that you'll be able to be on top of it.
Sir.
Yes.
Yeah, please. I will use any tool like QuickBooks or any software or something.
No. Your syllabus is not, computer as accounting is not in your syllabus. Yours is to get an introduction to it and then some management things. So we will not use any accounting software. It's the basic interpretation, calculations, and presentation.
Hello, sir.
No.
Please, our next tutor is waiting.
Okay, so we are finished. Thank you very much.
Okay.
Bye.
Bye.
Hello, can you hear me?
Yes, sir.
Let's start what we are going to learn today. Today, we are going to talk about variables. We are going to talk about variables in Qt and how we can utilize variables to achieve the aims in which we want. If we want a simple term of what a variable is, a variable stores data that the program can use and modify. So this is a simple form of the definition of a variable. A variable is a variable is a program that a variable stores data that the program can use and modify. So that is what a variable is. Stephen, can you mute yourself? Like when you want to talk, then you unmute. Okay. So a variable is now in our context. Visually, what is a variable? Visually, they said in an exam or if you are writing an exam, you can say a variable is a named memory location used to store data whose value can change during the program execution. Now, on your page, I've opened Excel, and then I'm going to see if I can demonstrate what I've just said. Over here, I have memory. So this is the memory. What I've marked as yellow is memory. Now, in the yellow thing in which I've marked, the computer has memory addresses, okay? So the computer stores the memory in addresses. So the computer would, by the way, this is supposed to be your RAM, not your hard disk, but your RAM. And the computer will take your RAM and give your RAM addresses. Let's say this is 0001. This would be 00010. This would be, let's say, 00011. This would follow on to 0000100, so on and so forth. It has given it binomial numbering so that it can know where items are. So if I am looking for something, the computer will say, okay, go to this position 0001, and then you will find the item in which you are looking for over there. So that is how the computer will use to find the items in which it has. Now, that means that if, let's say, I put 3 here and I put 4 here, the computer will tell itself that go to this location here, go and add whatever you have in that location to whatever that is in here. So you would go to the location 001, take the item that is there, in this case it is 3, add it to location 00011, and then you would get what? 7. Then you would tell the computer that, okay, go to 00100 and put the 7 there. So over here, I'll come and put 7 here. So this is how the memory does its addressing. Very, very simple. It puts an item in a particular location. It goes for the item, so on and so forth. Let's come back to the definition of what a variable is. A variable is a memory location used to store data. Therefore, in this view here, what is the variable? This is not the variable. What I've just made reddish. It's not the variable. It's the address. So if I want to go and pick an item, I will go to this address so that I can find the item in which I want. 3 is located in the address 00001. 4 is located in the address 0011. 7 is located in the address 0001000. The 3 over here is the value. So 3 is the value. The space, this empty space here, that in this empty space, I can come and put 2 here, or I can put 4 here, or I can put 5 here, or I can put 7 here, is what we call the variable. The variable is a named space. Named. Now, where does the name come from? If I say number is equal to 3, I can't keep track of the address system of the computer. It will be very difficult for me. First of all, I don't know where to put it for me to keep track of. Oh, we put it here. Imagine me coming to you and tell you, go and take 00001, add it to 0010. When you're done, go and put it in 000011. I will forget before I get to even 0011. So instead of me calling this address that the computer has called 0001, I would rather call the address number. So the moment in which I say number is equal to 3, then I've told the computer that, okay, create an address. I've created an address. Call that address number. And in the address you have called number, go and put there 3. So I've gone to put 3 in the address called number. Where I am putting the 3, the location I'm putting the 3, the space that I'm putting the 3 is what I will call the variable. So the number over here in programming, we call it the literal because it points to the space, and the space is the variable. Now, in the definition, we said that the namespace is used to store data. I've explained that, whose values can change during the execution of the program. That means that if I have a program, so over here I come in and I say number is equal to 4, it means that when you get here, create a space, put it 3. When you get here, go to the space and put there what? 4. That means that whatever that is there, it doesn't matter if something is there. To be honest with you, if something was there, it wouldn't even matter. I've just told the computer that assign 4 to my space. Go to where my address is and just go and put 4 there. That means that during the lifespan of the program, the information there can vary. The information there can change. The information there could be anything at any time of the program. It doesn't really matter. The data there doesn't matter. What matters is, where am I putting this information? And where I'm putting the information is in the address called what? Number. Please remember, we are not doing math. In math, if I say sum is equal to, let's say, 10, it means that 10 and sum are the same. In programming, the equal to sign is an assignment operator, which means I am giving. You would never see me in programming write 10 is equal to sum. That's impossible. I'll always write sum is equal to 10. Or I'll say this plus this is equal to sum. I always say sum is equal to this plus what? That. Because what I am telling the computer to do is that go to the right-hand side, do whatever computation you want, and go and put it on the left-hand side. So it will do whatever that is on this hand side, the left-hand side. It will do it. When it is done, it will go and give it, assign, give, equal to, assign, give. It will go and give it to sum. Therefore, it will create an address, call the address sum, and in sum, go and put the answer of it there, which is what? 20. In programming, all we are doing is manipulating variables. All we are doing, everything we do, your name, changing, all we are doing is manipulating the variable. It's changing the way the variable behaves. That's all we are doing. Changing the way the variable behaves. But there is a problem. And before I go to what the problem is, anybody who does not understand what I've just said, remember, this will form the basis of everything we are doing. So if you don't understand this, it is a problem. If you don't understand, let me know. Am I allowed to continue?
No, sir. Please, I don't understand.
What don't you understand?
From the number, the change of number,